We have a really interesting piece coming through from JP Morgan's Ed Yardeni, a note that he put out suggesting that maybe the door has opened to the bond vigilantes right now. Here's why. He says, look, the economic data out of the US has actually come out a little softer, and yet yields have continued to rise. He says it's not about the fundamentals, it's about concerns about the US deficit, and that has opened the door for these bond vigilantes to drive up yields, drive up the sell-off in terms of the bond markets. And he says if the Fed isn't worried about these unrelenting high yields, then they should be.
Yeah, Tom, I actually think it might be more about the shape of the yield curve rather than the level of yields. Because you look at your chart there, and you see those long-end yields, and they've been kind of going higher over the last 3 years. But the dollar, of course, is lower than its high a couple of years ago. And I think it's mapping even more closely what's happening in the yield curve. And that's why this bear steepening is so dramatic. And it goes exactly to your point about the return of bond vigilantes, which ultimately means a return of the term premium in the US Treasury curve. And I think that is what's really, really driving the dollar here. And I think the idea of bond vigilantes, or at least some care about the US fiscal situation, is a theme that's here to stay. So I think you're absolutely right to draw attention to Ed Yardeni's comment. Of course, he was a very initial person on the kind of bond vigilantes kind of 30 years ago on this idea. And I think this is going to be a real dynamic that's going to stay with us in the years ahead.
Yeah, we've talked a bit about term premium, haven't we, on this programme, and that clearly having some impact at the longer end of the bond curve and ties into that conversation. Really interesting on the dollar and on what's going on Treasuries. Quick check on the markets then. Let's get to the GMM for you and show you what we've got happening there. Stocks over in Asia, down 1.5% on the MSCI Asia Pacific. So some real weakness coming through on the Asian equity market story. Again, it's the higher yield story, it's the strength of the dollar. We're up 0.2% this morning on the dollar index. Interesting, we're getting a little respite linked to both of those on commodity prices. The oil price down at 90 with the handle on Brent, so 90.24, down 0.5%. We've got lots of currencies losing ground against the US dollar. We have sovereign bonds selling off in many places. Watching what's going on in Europe, though, things look a little divergent. Maybe it is what Tom was talking about earlier, the way that European bond markets were really roiled by Treasuries, and that conversation yesterday, so maybe a little respite there. We're buying sovereigns here, certainly on the German 10-year, the French 10-year, and those yields coming down just a touch. Commodities, a little bit of respite on that particular column on the GMM. Okay, let's check in on what's ahead for the Markets Today team. Christine Aquino joins us from the Markets Today blog and can take us through some of the top stories. Christine, good morning to you. So, there's a lot to talk about when it comes to the UK story. Let us start with food prices, and for a change, they're not moving higher. That's new news.
Absolutely, Anna. It is definitely good news. We know that the UK is still in the midst of cost of living crisis, and so we're finally seeing grocery stores succumbing to that fierce competition that we've seen over the last few months and actually cutting prices to compete with each other. We know that Aldi and Lidl have been increasing their market share at the expense of the more traditional British grocers, but really what stands out to me in the story is the fact that it's only now that we're seeing food inflation falling to single digits, right? We've had overall inflation in single digits for a few cycles now, for a few months now, but food inflation just now following suit, and that really shows you kind of the kind of lags that we're facing here. In fact, that, you know, food prices very much important to everyday living for Britons, not only falling, really paints a picture of the struggle that we're still currently in.
And important, of course, for the politics of the UK at a time when the Conservative Party is meeting for its annual conference in Manchester. And good news, welcome news, you would have thought, for the Prime Minister. Talk to us about the politics, what we're expecting to hear, or at least what the markets are going to be watching for from the Prime Minister, from the Chancellor over the next couple of days.
Well, Tom, we know markets love detail, they love policy clarity. They don't seem to be getting that so far from what we've heard from the Tories in Manchester. The latest focus, of course, is the status of the high-speed 2 rail, particularly moving toward Manchester. That's been very much a leveling up sort of policy that's being touted by, you know, key figures, political figures in that region, particularly the West Midlands mayor, and a lot of confusion over whether that's actually going through or not. And really, I think this indecision really isn't playing well with investors, with kind of political watchers. And, you know, ultimately, I think, you know, this will play out in terms of the Tories struggling to really make up that lead that they've lost to the Labour Party. And so, yeah, very interesting. It's a slow burn for markets, of course. They're terrible at pricing political risk, but definitely something to keep an eye on.
Christine, you talked about policy clarity there, and speaking of different types of policy, monetary policy, the lesson we've learned in the last 15 years is that when markets sell off, central banks have got your back and will just print more cash. But there's a Bloomberg article out saying that people are becoming disenfranchised with the idea of QE, as they're saying, the negative externalities. Do you really think that's the case? What's your kind of perspective on this?
Well, Mark, I think now hindsight is 2020, right? And more than 10 years on quantitative easing programs, we're seeing kind of the other side of it, which is really the repercussions when we are in a higher rate, higher inflation sort of environment. And I think there's a lot of kind of, I suppose, looking back at the repercussions of this policy. I think really Charles Goodhart was a former Bank of England rate setter, put it best. The policy was really great and it was appropriate for stopping panics in the short term, but it was never really meant to be a policy that lasts in the long term. The fact that it has lasted about more than a decade, and only now that central banks are starting the process or are in the midst of the process of rolling it back, that we're kind of seeing, the longer term implications of it. And in this sort of environment, it's not necessarily ideal when you have governments already dealing with higher inflation, higher rates, also having to deal with the losses in terms of the bond portfolios that they're still having to deal with on their balance sheets.
Okay, I'm going to go back to where we started the conversation because I just want to underscore what you're saying about the BRC figures. It's the month-on-month figure that's dropping on food, isn't it, Christine? So we're down by 0.1% in September on food prices, but that still leaves us up by 9.9%. And this just reminds me of some research I was reading recently. It was actually set in a US context, but it's probably relevant in other geographies, about inflation expectations. And, for the person on the streets, when they think of inflation, they don't necessarily appreciate that inflation prices can stop rising. They don't necessarily fall back down, do they? If inflation gets to zero, that doesn't mean anybody's going to go back to the prices of 2019. And I wonder how much that we're going to start moving into that kind of conversation around inflation and inflation expectations, contrasting what markets know well, I suppose, with what the person on the streets might be expecting to see.
Yeah, absolutely. And this is why I think you're absolutely right. It really feeds into the longer-term inflation expectations sort of spiral, because as you say, it's not like the person in the street is immediately feeling the effects of receding inflation overall, because what they're really seeing is the price of their food shop, which is still remaining elevated, especially compared to a few years ago. And so even if it is month-on-month marginally lower, it's still very much higher than in recent years, and that's ultimately what they're feeling. That's what's going to feed into future inflation expectations.
Okay, Christina Aquino from our Markets Today blog, thank you very much indeed for walking through some of those key themes for us with that UK focus and that UK lens. You can get more from the team on the front page of the Bloomberg UK website by typing TLiveGo on the terminal. Let's get your stocks to watch now with Joe Easton from our equities team. Joe, what are you looking at?
Morning, Tom. So we're starting looking at Novo Nordisk after news last night that the company has successfully convinced a tribunal to protect one of its patents for the key weight loss drugs, Ozempic and also Wegovy as well. Now, the US generic company Mylan had submitted a petition saying that one of the compounds used was an obvious compound to have chosen, and therefore they should have been able to replicate the drug and start producing their own version. But the tribunal threw that out, and we can see from the screen here that the US listed Novo Nordisk stock jumped around 4% from the low to the high in late trading there. Now, this is of course one of the key drugs that are seeing Novo's market cap overtaking LVMH, and there was a note from the analysts at Barclays. Here's those two market caps on the screen there. As I say, Novo becoming the biggest firm in Europe, but Barclays warned yesterday that there was risk around this tribunal and investors were a bit nervous, so that should be positive news today.
Joe, you're also looking at luxury stocks. Burberry, I believe, in particular focus. I think it's interesting because we seem to be getting a complete divergence here between the banks and the recommendations. UBS are negative Burberry, and I know Andrea Felsted from Bloomberg Opinion has written out a piece saying pick your luxury stocks like they're handbags, which I quite like this morning, and some other banks have just come out this morning saying positive in luxury stocks. What's your take on all this?
Absolutely, so it's a good read from Bloomberg Opinion on that dynamic there. As you say, we're seeing a divergence in what these single stock analysts are saying. So Burberry gets a sell rating over at UBS. They say that there's been a muted reaction to the latest collection displayed at the London Fashion Week by the new creative director Daniel Lee, and they say the price points are too high, which is interesting because it plays into the theme about the aspirational buyer potentially cutting back on their purchases. Also, generally, Chinese tourists not spending as much as they were in Europe as well. We can see this stock actually down around 7% year to date, and most analysts are sitting on the sidelines. 17 hold ratings, 4 buys, 4 sells, but UBS adding to the sells, becoming negative, and seeing 15% further downside for that stock at the moment.
Okay, and let's go to some UK retail themes. Boohoo cutting its outlook, and we've also had some news on Greggs. What caught your eye, Joe?
So Greggs looks like a pretty strong one. First of all, sales up 14% like for like in the 13-week period. They say the evening trade, something they didn't do much of before, this is after 4 p.m, doing pretty well. And they're also pretty excited about their new vegetable bhaji flatbreads, which sounds pretty nice to me as well. Meanwhile, Boohoo cutting their guidance. They say sales could fall by as much as 17% in the year ahead, partly due to the wet weather in July and August, but they also want general cost of living crisis, cutting the amount of money that people have to spend on clothes to go up. We can see those stocks both not having great years and potentially downside for Boohoo in particular today.
Okay, Joe, thanks very much. Bloomberg's Joe Easton from our equities team with the latest on stocks in focus. And Mark, we talk a lot about FX. Let's continue to do that. We see the dollar. It is still stronger this morning, but not quite as strong as it was.
Yeah, it's interesting because all we're doing is talking about dollar strength. That's obviously been the big theme, and that's been the thing that's squeezing markets right across the board. But during the show, over the last hour, 55 minutes, we've seen the dollar soften back from the highs. And that's very, very short term, providing a little bit of respite. And we're seeing some of the losses in stocks ease a little bit.
Okay, a little bit of short-term respite for the US dollar. Bloomberg dollar index up 10% down from the earlier highs of the session. Mark, thank you, of course, for spending the past hour with us. Futures pointing lower across Europe, down 0.5% and off by about 1/10 for S&P E-mini stateside. The open is next.
AutoCAD 係全亞至好嘅商業 software， 提供 accounting software、payroll、cost system 等等。只不過我公司細，budget 低咧 ，software 冇budget喎。而家政府為中小企業嘅商業 software 提供50%嘅 matching 㗎啦，補助金啊！50%，即係我俾一半，政府俾一半。係啊，你唔早講，呢啲都收你錢啊！咪就係，走！喂，你喺邊度啊？佢攞個扣啊！喂，你俾錢啊
！Is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Wall Street is waking up. Europe is already trading. And Mattis Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Mattis in New York and Danny in London follow the money around the globe. take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
A few minutes to go until the start of cash equities trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom McKenzie.
And here are your top stories. One more. Cleveland Fed President Loretta Mester says the US may need to raise rates once more this year and hold them at high levels for some time. Standing back, the Aussie dollar and bond market remain unfazed as the RBA keeps rates unchanged but warns further tightening may be required. Stocks in Asia sell off. Plus, JP Morgan CEO Jamie Dimon says AI will lead to a 3.5-day work week, at least for some. We're going to bring you more from our exclusive interview. The focus, then, still on the dollar, still on the yield story and the futures pointing lower here in Europe.
Yeah, absolutely. Not on the 3.5-day work week. We'll save that. We'll save that one.
We'll hold that hope.
We are a minute away from the start of cash equities trading then here in Europe. So let's have a look at where we are across a number of assets while we're all still here working the 5 days. This is MSCI Asia Pacific down by 1.5%. We're at lows of the year. We're at lows of the year for the euro. We're also at lows of the year for the yen, but we haven't got that in the ball because it didn't quite go through 150. We're on 150 watch though. It's not far from it, but this is where we are in Asia Pacific stocks selling off. The US 10-year yield, part of the reason for that. The euro 104.73 as we continue to watch that weakness. Certainly that was a focus for markets yesterday. And the Brent crude price at 90.41, dropping a little, down by 0.3%. With a 90 handle, Tom, that is not the 95 that we saw last week. So getting a little bit of respite there on oil prices and on commodities.
Yeah, the oil price respite though not leading to any upside in terms of these equity markets. Futures pointing lower for Germany by around 0.4%. Here in the UK, the FTSE 100 pointing down by 15 points. Over in France, you're looking at a drop of maybe 0.5%.
Okay, so looking to a bit of weakness at the start of the European trading day. That certainly would be in keeping with what we've seen through the Asia session. The higher yields, the stronger dollar, all of that taking its toll on risk appetite. That was the story through Asia. How much will that filter through into Europe today? We did a little bit of this story yesterday, of course, but we're continuing to watch those yields ratchet higher. Those cycle highs, new cycle highs on the 10 and 30-year yield, all of that continues to do more damage. So the Spanish IBEX down 0.5%, FTSE 100 down 0.2%. This is what we see on FX markets there. This is the ongoing strength in the dollar, although to Mark's point at the end of the last hour, a little bit less strong than it was at the start of the last hour. The euro fairly flat, the pound fairly flat, as I mentioned, still on dollar-yen watch when we get to that 150 mark. And our colleague Mark was pointing out all the options pricing, keeping it in check at the moment, and suggesting if it goes through 150, then it could really move further than that. This is the sovereign bond column there. We're seeing actually in Europe a bit of a different picture to yesterday. Yesterday we continued to see the bond sell-off in the US, higher yields, and as Marcus Ashworth was writing about, that really did do damage to European bond markets. Well, today looks a little bit different. We see some buying there, and we see some of those yields coming down on sovereign bonds. Tom, what do you see on the sector picture?
Well, just one sector clinging on to some very, very modest gains in food. Every other major sector is in the red. Let's focus in on the energy story again. So this is a theme, of course, that continues from yesterday. Anna flagging the fact that Brent is around or just below that $90 a barrel level. And of course, there's a squeeze there. The analysts say, look, this is less about the fundamentals, more about that dollar story, more about the yield story. Energy as a sector currently down 0.3%. Basic resources also taking a knock down 0.5%. You do have some coming back in terms of the traders in Hong Kong after that holiday. Mainland China remains closed. Tech is currently down 0.5%. And in terms of what's happening across the retail space, 0.6% is the downside there. The banks are under pressure as well by about 0.4. Utilities lower as a sector, ended lower amongst the biggest losers across the sectors yesterday and today, down 0.7%. Across the benchmark, you're looking at losses of around 0.2%.
Okay, so quite fairly broad base there, those modest losses across European equity markets. Let's talk about what's going on the markets today with Christine Aquino, who joins us once again from the Markets Today blog to take us through her thoughts. And Christine, you can't move for comment and reference to treasuries right now. That seems to be what it's all about. I mean, what is it that just keeps driving treasury yields higher? We've talked a lot about the long end of the curve, and maybe there's nervousness around supply there. And is it the fact that we're not getting much pushback from all of the Fed voices we're hearing? They're not saying, hang on, we've gone far enough, we've priced in enough hikes. We're not getting that kind of commentary, and that just leaves the way clear for higher yields.
Yeah, absolutely. I mean, it really is a combination, again, of the supply issues that you mentioned, and of course, ongoing concern about the ballooning deficit that just really keeps growing in the U.S., but also the fact that, yes, we are in this higher for longer environment. And when we say higher for longer, it really is not just about the rate itself. It really is also about the corresponding inflation that central banks will have to keep dealing with for some time. And I think there really is a realization in the last few weeks in the bond market that, hang on a minute, with rates staying as high as they are for a foreseeable period, we're also going to have to deal with inflation that's really going to be above target much longer, perhaps, than central banks were hoping or expecting. And we're really seeing that in movement in yields, not just in the U.S., but really across the world.
Yeah, and arguably that high yield story is not helping the Bank of Japan. We remain on 150 watch for the yen, currently at 149.67. How are we thinking about the potential for intervention from officials in Japan?
Well, Tom, I mean, certainly on high alert at the moment, especially because we are hitting those levels again that we have seen in the past, very much made the Ministry of Finance in Japan nervous. And, it's a very interesting dichotomy here that we're seeing because, of course, the impact on the yen is very much coming from the Bank of Japan's policy of really sticking to that yield curve control measure still, right? I mean, even though they have indicated some baby steps away from that and more toward normalizing policy, it's very clear that their priority is to keep yields in check. It's also very clear that they are very much leaving the management of the currency itself to the government, which is, of course, under its remit, but, of course, puts the government in a tight spot, having to really watch the yen levels and make sure that it doesn't go much weaker than it currently is.
Yeah, remain on intervention watch as the yen skirts that 150 or flirts with that 150 level, currently 149.68. Christina Kino, thank you very much indeed. From our markets today blog, walking us through some of the key market themes. You can get more, of course, from Christine and the rest of the team on the front page of the Bloomberg UK website by typing TLiveGo on the terminal. Let's take a look now at some of the other big events we are watching out for today. 1 p.m. UK time, we're going to hear from Atlanta Fed President Raphael Bostic, who's participating at a roundtable discussion. Interesting to see what he says on the back of Loretta Mester's comments that maybe additional hikes are needed from the Fed. And at 3 p.m. London time, the key data drop of the week, we're going to get the monthly US jobs opening numbers from the Labour Department. We also, of course, have later this week non-farm payrolls, arguably as consequential, if not more consequential. Throughout today, we're expecting a number of ECB speakers, including Philip Lane, and we've been hearing from Philip Lane, in fact, on his views around inflation, and Francois Villeroy de Gallo. We're going to bring you highlights and headlines as they cross the terminal. And at 3 p.m. UK time, Bridgewater Associates founder Ray Dalio, heard of him? Going to be speaking exclusively to Bloomberg from the Greenwich Economic Forum in Connecticut. That's going to be interesting to hear what he says. He takes very much a macro look now. He has strong views on China, and of course, he may well talk about the US and deficit problems as we look at what's happening in the bond markets in the US.
Lots to focus on when it comes to the jobs story in the US a little bit later on. We've got the job openings story, of course, to zoom in on. And actually, we've seen these numbers coming down in keeping with these cracks in the labour market that we've been talking about since January 2022. But Bloomberg Economics actually say that they expect this number to increase today. They're not reading too much into that, but they do say that that could be a risk. Although the overall estimate is for that number to drop on the sort of Waco function on the Bloomberg terminal. But that's going to be a focus. Still looking for cracks in the labour market, really, aren't we? Even as the focus more on the sort of the downturn, the weakness in the US economy, rather than maybe labour market.
Well, it doesn't seem that long ago that it was 2 for 1, the ratio in terms of job openings for applications in the early part of this year, pointing to the strength that was coming through for the US labour market then. But yes, we are seeing a little bit of fragility, and it ties into the Bloomberg Economics piece yesterday from Anna Wong and team, Tom Wallach, of course, in terms of the expectations that the US is unlikely to avoid that soft landing because they are starting to see some fragility. That's part of their argument in that labour market.
Yeah, absolutely. And you mentioned Philip Lane. We've already heard from Philip Lane, and he's putting the focus on how long it will still take to bring down inflation, saying we still have 2 more years of fairly large wage rises. That's his commentary, a host of comments on the Bloomberg Terminal from Philip Lane speaking there this morning. Coming up on the programme, we will talk more about the Fed. Cleveland Fed President Loretta Mester says 1 more US rate hike will probably be needed this year to tame inflation. More on that next. This is Bloomberg.
Me, Max. I have been writing about Wall Street for almost 15 years, and what that means is I write about feuds and rage and rises and falls and comebacks, and every now and then I also write about a couple of villains. Thank you so much. And now I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Business Week magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg.
It's turned to the U.S. job market.
The jobs report, it looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for. They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
This is Bloomberg Markets today, 10 minutes into our European trading session, and higher yields, stronger dollar taking their toll on risk appetite. You can see European stocks just under pressure a little bit. We are down a couple of tenths of a percent on the Stock 600, a quarter of 1% in fact. The FTSE 100 holds up a little better than the rest. The CAC and the DAX both down 0.4% this morning. Let's get to some of the individual stocks on the move. Joe Easton has a briefing. Joe.
So we are seeing sharp declines in the online clothing retailers today after that warning from Boohoo saying sales could fall as much as 17% in the year ahead. That stock leading declines in the UK down around 9% as customers do cut back on their clothing. Also hitting ASOS, who warned just a couple of weeks ago that they'd had a poor summer, partly due to weather, and we're seeing declines as well on Zalando over in Germany. The German online clothing peer getting hit as well. Red across that sector this morning. Greg's coming down a bit. That sales update looked pretty strong, double-digit sales growth in the last 13 weeks, however potentially moving lower with the broader market, and that one still remains quite a highly rated stock in terms of its valuation, given the gains that we saw a few years ago for that one. Then we'll flip over and I'll try and remember what we were going to do on the next board. As usual, I have completely forgotten. Novo Nordisk, of course, we had that one in stocks to watch. They won a patent dispute in the US. The tribunal there said that Mylan, the US firm, is not able to copy one of the compounds that they use in the key drug Wegovy. That one's actually the best performer on the stock 600 today. And meanwhile, we've got Sika, which makes grouting, so a very glamorous one there, grouting that goes in tiles. They've issued a sales update, not as strong as expected over in Switzerland. That one coming down. Then we've got Burberry, as we said in stocks to watch as well. UBS cutting that one to sell, among 4 analysts now saying they should sell that stock. This after the latest collection from the new creative director Daniel Lee, which I saw on their website, includes a hot water bottle which prices at £290. It's one way to spend 300 quid, I guess. But anyway, we've also got Bruno Cucinelli going the other way. They've got an upgrade from a broker over in Italy. Second upgrade. Goldman went by a few days ago on that one. A lot of positivity on cashmere sweaters. Meanwhile, moving over into kitchen supplies, Rational Group over in Germany, they make combi ovens that go into restaurant kitchens. They're seeing weaker orders, according to Berenberg, that one coming down 4%. And finally, JP Morgan goes overweight Technip Energies, the industrial engineer supplying into the energy sector. They say rising oil should benefit that one, and that one is up 2.3% in Paris.
Joe Easton, what are you going to do with a £300 hot water bottle?
Seems a bit extra.
Surely the prospect, part of the rationale for buying luxury is so you can show it off to people, right? In terms of, I mean, it depends how many people you have in your bed, I guess. 300 quid for a hot water bottle. I was also expecting, Joe, a little rundown of the menu from Greg's, but we'll come back to you on that one, because you always catch Chicken Goujon's doing well on Greg's. Thank you, Joe. Joe Easton, of course, from our equities team on the important stocks on the move this Tuesday morning. Let's get back to the macro now. Cleveland Fed President Loretta Mester has signalled that further tightening may be needed this year to bring down inflation. Mester, who doesn't vote on monetary policy this year, said inflation remains too high and the risks are still tilted to the upside.
At this point, I suspect we may well need to raise the Fed funds rate once more this year and then hold it there for some time as we accumulate more information on economic developments and assess the effects of the tightening of financial conditions that has already occurred. But whether the Fed funds rate needs to go higher than its current level, and for how long policy needs to remain restrictive, are really going to depend on how the economy evolves relative to the outlook.
Okay, let's bring in Freya Beamish now, Chief Economist at TS Lombard. Good morning, Freya. We have a market that's reassessing their expectations around a potential hike from November from the Federal Reserve. We had additional officials, of course, coming out signalling that at the very least higher for longer remains the narrative, and then some, like Loretta Mester, flagging potentially additional hikes coming through. Where do you land on this debate, given so much work has been done by the bond markets to tighten financial conditions?
Yeah, they don't know. And to be fair, if anyone tells you they do know, then they're probably a little bit egotistical, because there's just so much uncertainty about the US outlook. We do think that probability, when it was hanging about kind of 50-50, that was a little bit too low for the November hike, just because of that uncertainty that's still out there. And the reason why there's so much uncertainty is because we are in unprecedented times with regards to the wealth ratio in the US. So the amount of wealth that was created by the pandemic. In the US, that is still overhanging, whereas in the rest of the world, it's very much diminished. In the UK, it's actually completely gone. So in the US case, all of that kind of tightening that has happened already is sort of much less effective on the economy. The economy is sort of desensitized to the tightening of monetary policy by the kind of the cushion of wealth that is left over. We still do think that you can get a recession. A little kind of thought experiment that we've been doing is to think of, well, you've got the household sector and they're sitting pretty with this extra wealth. but you don't get more spending out of them. They can sort of maintain their spending. They can maybe continue to buy their luxury hot water bottles, but they don't grow their spending because the stock of wealth is larger. To understand what's going to happen to GDP growth, noting that GDP is a flow, we have to look at the change in the impulses coming into the economy, and those are negative for the moment. So we've got a negative credit impulse, and that tends to be a coincident indicator with GDP growth. There is, though, this kind of desensitization to the impulses because of the excess kind of stock of wealth, and the fiscal impulse has been adding to growth as well. So there's a lot of uncertainty out there, and that's why the Fed just has to play it by ear.
Okay, a lot of uncertainty, and you make the point you're watching the change in the change, if you like. Let me ask you about what breaks from here, Freya, if anything. I was reading an interesting piece by our colleague John Authers, who was saying that, the surging bond yields, we talk about it day after day, and you just wonder what will break. Is there something, an asset class that you have in mind? I mean, people are talking about how corporate credit isn't necessarily priced for the level of rates that we've got right now and the risks surrounding defaults there. What are you looking at?
I think that in terms of defaults from the real economy side, what we're seeing is only at the kind of the most risky end, you're starting to see delinquencies pick up. For instance, credit cards in the household sector, and that's the kind of the early warning signs that you might kind of look to for things starting to be more painful. But again, this is more of a sort of it's almost like a statistical correction if there is a recession. It's not like there's something that needs to be corrected in a global financial crisis sense, or in the sense that we have in China currently. It's more just like the economy has overrun. It's well above its kind of trend rate of growth in terms of the levels. And it needs to slow down a little bit. So in terms of something breaking, I think the likelihood of something breaking is actually quite strong, because you still have the kind of the legacy of that long period of low rates is still with us. And the authorities need to drain the swamp. And while you're draining the swamp, you're going to find out that kind of something is there beneath the surface. But it's really hard to actually get real yields falling until those recessionary numbers come through. The mechanism for yields falling would be you drain the swamp, you continue with the QT, you perhaps have a little bit of help with the Bank of Japan continuing to normalize rates and to normalize policy. You have the TGA rebuild, and that's all draining the swamp, and that pulls up real yields. And that tends to pull down growth and inflation, and then you stop draining the swamp, and you perhaps get a fall in real yields at that stage.
Well, talking of draining the swamp, we've been hearing from Philip Lane of the ECB suggesting that more work needs to be done. Not at the inflation target yet, more work has to be done. But you're concerned that maybe there's over-tightening coming through from the ECB?
Yeah, we can have a lot more conviction on the European case than we can have on the US case, and I think that's why the dollar story is so popular at the moment. A lot of uncertainty on the US case. In the European case, that cushion of wealth is pretty much gone. If you include housing, there's a little bit of a cushion left, looking at sort of financial wealth and housing as a percentage of GDP in the euro area. In the UK, we've actually gone negative, so we've got less wealth than we had prior to COVID and even before that. As a percentage of GDP. So there's nothing there, there's no buffer in the UK case, and there's only a very small buffer in the European case. And that really tells me that the ECB and the Bank of England have been fighting a very different inflation monster than the Fed has been fighting. They've been fighting imported inflation, they've been fighting negative supply shock driven inflation, cost push inflation, and all these types of things tend to destroy demand by themselves. They really didn't need so much of the kind of the tightening probably from the Bank of England and the ECB. And so the outturn is in terms of the relatives, the likelihood is the ECB and the Bank of England probably have even over tightened by this stage, whereas the Fed, it's not even clear that they've done enough tightening.
Freya, thanks so much for joining us. Freya Beamish, Chief Economist at TS Lombard. Coming up on this programme, watch collectors are still wary of spending big on top Swiss brands. We will discuss the market for fancy timepieces next. This is Bloomberg.
2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
This is Daybreak Europe. I'm Pretty Gupta. Listen to the stories that set your agenda.
Taking you from the U.S. market's close,
Along with what's priced into the U.S. session,
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back now. Prices for pre-owned Rolex watches kept falling on the secondary market last month. Meanwhile, entry-level models and brands like Cartier and Omega have fared slightly better. For more on the market for fancy timepieces, let's bring in Bloomberg's Swiss watches reporter. What a gig, Andy Hoffman. Andy, has the secondary market then for luxury watches finally bottomed out?
In a word, Tom, no. Prices are continuing to fall. We now have sub-indexes, branded indexes, part of the Bloomberg Sub-Val Watch Index. We saw Rolex prices fall about 2.2% over the past 30 days. The overall index, which includes the 50 most traded watches by value, so lots of Rolex, Patek Philippe, Audemars Piguet, down about 2% over that same period. We also now have cheaper sort of entry-level watches, an index separately for that. That was only down about 0.8% in the past 30 days.
Okay, so you mentioned a few of the brands there, but what is it that collectors and enthusiasts are looking for right now?
Well, you'll remember that basically prices for luxury watches, particularly Rolex, Patek Philippe, and Audemars Piguet, went crazy during the pandemic. And once interest rates started to rise about in March, April 2002, prices started coming off. We're still there, but it seems like what collectors and enthusiasts are looking for now is more value. So they're moving to brands like Cartier, like Omega, like Breitling, and even Tudor, which is the sister brand to Rolex. And so those watches have still declined in price, but they have declined at a less precipitous rate than the big, most hyped watches. So we've in fact seen prices for Cartier watches up over 12 months during the year, up slightly, whereas prices for Rolex or prices for the overall index are down about 12%. Thank you.
Thank you very much, Andy Hoffman, our Swiss Watches reporter. Coming up, JP Morgan CEO Jamie Dimon, we talked to him about AI.
What if I tell you that there is a product that can help you improve your skin hydration without irritating it? Would you be open to try it?
Yeah, sure. Come, follow me.
No sticky at all. I love it. Wow, that's amazing.
focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI
stands for. More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford. You know, next fall. But then our take was, that's great. You can have these amazing giant general models. What would be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models are like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things. But that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. One more, European equities and US futures drop as Cleveland Fed President Loretta Mester says the US may need to raise rates once more this year and hold them at higher levels for some time. Standing pat, the Aussie dollar and bond market remain unfazed as the RBA keeps rates unchanged but warns further tightening may be required. Plus, JP Morgan CEO Jamie Dimon says AI will lead to a 3.5-day work week for some. We'll bring you more of that exclusive interview with Tom. That coming up shortly, more of that AI conversation. European equity markets then sluggish at the start of trade, very much the hangover of the higher rates, stronger dollar story we saw through the Asia session, but London turning corner just a little.
Yeah, building on the downside across the benchmark, down 0.3% as things stand. The inflation picture out of the UK is interesting. You're seeing moves in the gilt market on the back of that, money moving into gilts and yields coming down. And that is on the fact that grocery prices, shop prices have come off, and so expectations that maybe we're seeing a little bit more certainty around the downward trajectory of inflation here in the UK. Across the benchmark, as I said, the losses are 0.3%. Over in Germany, the DAX taking a hit of about 74 points, down 0.5%. The FTSE 100, though, flat as things stand, just gaining a little under a full basis point, 7,511. Interesting that you get a call from the likes of Citi and Bank of America saying, and this of course reflects with the CAC, but also the UK, the FTSE 100 as well, that maybe now is the time to buy the dip on luxury. Let's switch the board and have a look at the sector picture then. We'll focus, of course, on energy, but also basic resources, given that iron ore and copper prices are down in the session as well. So energy down 0.8%. That was one of the biggest losers across the sectors yesterday. Autos proving something of a drag, of course, for the DAX, currently down 0.6%. A big hit for utilities. That was the biggest loss leader in terms of your sectors yesterday. Utilities in the session today down 1.6%. And there's the basic resources picture then down a full percentage point as well. There isn't much resilience across here. Food, travel and leisure, the least badly performing sectors across the board here. There are a couple of sectors that are in the green, not reflected on this channel, or at least this board right now. Across your benchmark again, losses of 0.4%. The FTSE 100 is range bound.
Okay, JP Morgan CEO then, Jamie Dimon, says AI is already being used across the bank. He spoke in an exclusive wide-ranging interview with Bloomberg's Emily Chan in London.
It's a living, breathing thing. It's going to change. There are going to be all different types of models and different types of tools and technology. But the way to think about it for us is every single process, so errors, trading, hedging, research, every app, every database, you're going to be applying AI. So it might be as a co-pilot. It might be to replace humans. Like, AI is doing all the equity hedging for us for the most part. It's idea generation, it's large language models, it's note-taking while you're talking to someone, and while taking notes, it may actually say to you that, here's the thing of interest the client might be interested in, all error, all customer service. It's a little bit of everything.
But it is going to replace some jobs.
Of course, yeah. But I look, folks, people have to take a deep breath, okay? Technology's always replace jobs. Your children will live to 100 and not have cancer because of technology. And literally, they'll probably be working 3.5 days a week. So technology's done unbelievable things for mankind, but planes crash, pharmaceuticals get misused. There are negatives. This one, the biggest negative in my view, is AI being used by bad people to do bad things. Think of cyber, Henry Kissinger talks about warfare. But the fact, and I do think, eventually have legal guardrails around it. It's kind of hard to do because it's new, but it will add a huge value. And for JP Morgan, if it replaces jobs, we hope to redeploy people. Like at First Republic, we've offered jobs to like 90% of the people. They accepted, but we also, we've told them some of those jobs are transitory, but we hire 30,000 people a year. So we expect to be able to get them a job somewhere local in a different branch or a different function if we can do that. And we'll be doing that with any dislocation that takes place as a result of AI.
The biggest tech companies prop up a huge chunk of the S&P. Is big tech too big to fail?
I think that's a too broad a question. I think in any industry, when you say too big to fail, which I've lost touch with what that really means anymore. Because remember, car companies are bailed out, these things are bailed out. And, I don't understand. They should ask what they want. If the regulators don't want a bank to ever fail again, then we should do A, B, C, D, and E. If that's the goal. I didn't think that was the goal. I think Dodd-Frank actually accomplished most of the goals, which is dramatically reduce the risk, create liquidity, capital, and stuff like that. And big tech's got to be very specific. Sometimes companies misuse their position, and sometimes they don't. Sometimes regulators capture it, sometimes they don't. But they're powerful. And we have to deal with that. I've been writing about, big tech going to our business. We got fintech, but we also have big tech, and they will embed payment systems in there. Some are going to white label banks, kind of what Apple did. They have the right to do that. I'm not against that. I would be against unfair use of their position to dominate us in a business.
Well, Apple is going deeper into financial services. Do you worry about the Bank of Apple?
I wrote about it like 5 years ago.
Well, how worried are you now?
What is a bank? Well, we're going to compete. So they have a tough competitor, but they hold money, move money. You can put money in basically markets, but it's a white label, checking account, credit card, all these things. Yeah, they're a form of a competitor. We also partner with them, but I'm very used to partnering and competing with lots of people.
Existential threat?
I don't think it's an existential threat, but I think if we were complacent about it, yes.
Okay, JP Morgan CEO Jamie Dimon there speaking to us exclusively on the challenges and the opportunities around AI. His views, of course, on big tech as well, and the competition with Apple and their partnership with Goldman Sachs, Marcus offering. Interesting around the 3.5-day working week that he flagged there to Emily, and it brings me to a comment. Do you remember that? Well, I'm not going to try to 1930s. So I'm not going there. John Maynard Keynes, famously, in terms of the essay that was published in the 1930s. Did you remember? We're going to go there. People would only work for 15 hours per week, is what John Maynard Keynes, the esteemed and famous, famed economist, scores back in 1930 because of productivity gains. Now you have Jamie Dimon saying we're going to be working 3.5 day weeks. I think you have to take that maybe with a bit of pinch of salt. Whilst you also got to weigh his smart analysis on how this evolution is going to change the workplace.
Really excited to hear his view, isn't it? 3.5. I wonder how he gets to the half.
The half is important.
That suggests some deep analysis, doesn't it? That wasn't just plucked out of thin air. 3.5. That's not 2, and it's not 5, it's not 4. Interesting. Well, you still have to spend 5 days in the office. That's what I want to know. If you're working 3.5 days, but that's a silly question. Interesting on tech displacement, though. Of course, at the individual job level, he's right. Tech has always replaced jobs, and that's what we've seen decade after decade after decade, but not at the overall labour market level. And that's the concern with AI, isn't it? Because it has it has replaced jobs, but then those people have found jobs doing other things. That's why we have really low unemployment levels in many Western economies right now. So that's why people ask, is it different this time with AI?
Yeah, and what a lot of proponents will say is that you see a labour force, you're going to see a labour force that incorporates some of those AI solutions to empower workers, and it's not going to necessarily lead to that bloodletting. The question is, have you got the training in place when those jobs are let go?
Okay, let's stick with this theme. In fact, while investors have piled into AI bets this year, Wall Street has been slower to succumb to the new technology. Computers have struggled to decipher noisy markets, but there are signs that this is shifting for more. Let's bring in Bloomberg's cross-asset reporter and author of today's Big Tech Story, Justina Lee, with analysis. Justina, good morning. I'm really interested that setting you up there with JP Morgan's commentary, because of course he was talking about what they're doing on the AI front. We've seen AI advances in lots of industries then. So how is the technology making a mark then in finance?
Yeah, I think a lot of Wall Street is using it the way a lot of industries are. I mean, when I spoke to hedge funds earlier this year, they were really excited about using ChatGPT to summarize all the reports they now don't have to read, or to kind of like read signals from a lot of the news that we write and a lot of the tweets that we post. I mean, a lot of quants are trying to get signals from that text data without ever having to read a word. But I think the holy grail remains like using machine learning to know where markets go next and to trade based on that. And I think a lot of hedge funds are still relatively cautious about that part.
What are the challenges? Why is it proven so difficult for the industry to incorporate AI to kind of shoot for those aims and those goals? Why is there still such a gap?
Yeah, that is a great question. And I think if we kind of begin with definitions, I mean, like a lot of traditional quant models, I mean, you're beginning with the hypothesis, so you kind of know the logic behind your models. But with machine learning, you're sort of feeding all this data into a black box and asking it to detect these complex patterns for you and spit out a prediction. But the problem is financial markets are really noisy, so a lot of the time the machine doesn't know whether it's kind of seeing signal or noise, and if you're just like finding patterns out of noise, then that is not necessarily going to work, especially with like regime changes, it's not going to work in live trading.
Okay, yeah, really interesting. So to the extent to which AI can disentangle the things it should be reading and the things it shouldn't. So where does this leave us then, Justina? I mean, are we at a point where some kind of AI can pick a load of stocks for us?
Yeah, I mean, I think a lot of hedge funds definitely are saying it can do that. I mean, I interviewed one based out of Berkeley called Volion, and they've always been at the vanguard of this fight. And I think you can see a lot more quant funds experimenting with AI for sure. But if you look at the track record so far, I mean, it's definitely not going to like shoot the lights out. It is not going to replace all the human stock pickers. And I think it just goes back to the same lesson, which is that predicting a market, especially as efficient as the US stock market, is just really hard. But at the same time, I mean, if machines can do as well as humans, maybe you don't need as many humans.
Yeah, or if machines show it's not possible. That's also interesting in itself. Justina, thank you very much. Bloomberg's Justina Lee with the latest on AI, where it meets big finance. You can read today's Big Tech Story, NI Big Tech Goes, the function to use on the Bloomberg terminal. You will also find that story on the Bloomberg website. Coming up, we'll be speaking to the Bridgewater Associates founder, Ray Dalio. We'll be hearing from him from the Greenwich Economic Forum in Connecticut. You can catch that conversation at 3 p.m. UK time. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding the new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp
wasting all your energy on it.
Can it go to 7%? The answer is yes. Are there factors that would drive it, higher than, where it is today? 4.5, 4.6, or 4.7 over the 10-year bond now? Yes. Is supply and demand could push out? Yes. I'm just saying, be prepared for it.
So,
and then the worst case is stagflation. Higher rates because you have a booming economy and there's a lot of competition for capital is not the same thing as stagflation.
what are the ripple effects of the stress of that 7% rates on business, on your growth?
Well, I'm not worried about JP Morgan. JP Morgan, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too. That risk management is not the same thing as guessing the future. When risk management look at the range of potential outcomes and being able to say to yourself, we can handle this, we can handle this, we don't really expect it, and we can handle the in between. If you bet your company on one outcome, so I think all companies do that. Every company's got different exposures. Input prices, output prices. Some interest rates don't matter. Some it's the price of mozzarella. So what's your business? Your business is different. So, but I think we don't know the effect of these things on the economy. So we may have a soft landing, we may have a mild recession, we may have a hard recession. Obviously there are potential bad outcomes. The worst one would be economically is stagflation, where you have low growth, high interest rates, and obviously if that happens, you're going to see a lot of people struggling.
Regulators have proposed new capital rules that banks have said will make it tougher for Americans to get a mortgage. But I'm curious, when you look across the firm, what businesses are going to have the biggest impact?
When you get into the specifics, it really matters how the ultimate rules about mortgages and small business loans, et cetera. In general, it makes, what I don't like about it, for example, it punishes diversification, operating risk capital, and GSIFI. And diversification is one of the true free lunches for a bank that protects it. And I don't understand why they do that. And I just, we're going to be responding. Hopefully it'll be modified and thoughtfully done for international purposes. And mostly, America's got the best financial system the world's ever seen. And that includes hedge funds and private equity and private capital, all things like that. But this is, I said that private equity hedge funds are dancing in the streets. And this time they're being quite public about it. Because this is going to push a lot of stuff out of the banking system. And if that's what the regulators want, so be it. Is that good for America? I don't know.
JP Morgan Chief Executive there, Jamie Dimon, speaking to us exclusively. Now, the UK Conservative Party conference is underway in Manchester. Bloomberg's Caroline Hecker joins us from there with the guests. Caroline.
Good morning, Fossey, and thank you so much. So, to give you the background here at Manchester Conservative Party Conference, the annual gathering, the Prime Minister is under fire for not making a decision about high-speed rail 2. This is a multi-billion-pound rail project that is meant to bring high-speed rail right here to the city of Manchester. He says he doesn't want to make a premature decision, but there is a cabinet meeting taking place today about that. The other issue is around tax cuts. The Chancellor and the Prime Minister have refused to make any pledges or commitments on tax cuts, including in the Chancellor's speech yesterday. But the other big event here in Manchester was the former Prime Minister Liz Truss. Undaunted by her short and pretty disastrous tenure last year, she addressed a packed room of Conservatives just over the road yesterday, making big promises. Make Britain grow again was her tagline. She also talked about the need to build 500,000 homes in the UK. That really is a staggering figure. Joining me now to discuss this and what is happening at Conservative Conference is Rachel McLean, who is the UK's Housing Minister. Good morning. Thank you so much for your time and for joining us. Liz Truss advocating for 500,000 homes to be built in Britain. Okay, admittedly, she's not in government, but the Liberal Democrats want 400,000 new homes to be built. There are big ambitions. What do the Conservatives want to do?
Yes, I mean, look, where I completely agree with this is we just need to build more bloody houses, as I think the young Liberals have said. So, as Housing Minister, that's my job. I'm getting on with doing that. We've actually had a pretty good record of house building over the last 5 years under this Conservative government. There are some things we are getting right on this agenda, but there's obviously a lot more to do, and that's what we're focused on. We're in the middle of taking some long-term decisions about housing in places like London, Cambridge and Leeds, talking about how we're actually going to, over the long term, grow those places to make sure we've got enough housing for people.
Is there a bit of amnesia at this conference? The Conservatives scrapped a target of 300,000 homes to be built a year because it was unachievable.
No, we didn't. No, we've never scrapped the housing targets. We still have housing targets of 300,000 homes a year. If you look at our delivery, we've actually got the highest house building on record in the last 5 years compared to the last 30 years of housing delivery. As I said, there's more to do, but it's completely wrong to say we've scrapped housing targets. We still have those targets, and we're getting on and building those homes.
Okay, and just to confirm, also we're getting on the Bloomberg Terminal this morning, confirmation now that the Prime Minister Rishi Sunak is going to hold that cabinet meeting today to make a decision about HS2, the rail project. I mean, this has fissured the Conservative Party, whether, you know, even the Conservative Mayor of the West Midlands, Andy Street, says that backing out of this, it's a once-in-a-generation opportunity and it's missing a key target on levelling up if it is not delivered. If the Prime Minister decides to back out of levelling up, that's a disaster for Britain, isn't it?
Well, I don't think you should really frame this as backing out of levelling up. It's not, to be clear. This is one project that was started a long time ago under a different government. Since that time, we have ambitious levelling up projects all over the entire country. We've delivered free ports, we've delivered investment zones in my own portfolio, we've delivered levelling up partnerships. Towns Fund just this week announced £1 billion going to a number of different towns across the country to regenerate their high streets and their town centres. And look, I think the Prime Minister is right, to be honest, with the British public about the cost of HS2. It has spiralled. You know, when I talk to my constituents in Redditch, what they want is decent bus services. They want trains to Birmingham. They want to be able to get around the region. So we obviously have to look at this through the lens of a tight public spending settlement.
It is confirmed now that HS2 has now been scrapped, the leg to Manchester.
You just heard that.
Just heard that. I've just been told. So you're getting the news as I am.
Okay.
Okay, awaiting confirmation then in terms of HS2. All right, so we know that there's a cabinet meeting, so we're waiting to understand and get some clarity on this issue. All right, listen, returning to the housing portfolio, your portfolio, the crisis in the rental market, spiralling costs, you've got 3 times the pace of inflation in terms of rental increases in Britain. Again, how does the Conservative government address this pressing issue?
It goes back to what I said in answer to your first question. The way we address this crisis is by building more houses of every type. We have a mismatch of supply and demand. We've got very high levels of immigration, both legal and illegal, to this country. We've got demand spiralling for housing. I mean, when you talk about immigration, housing doesn't discriminate between someone who comes here illegally or if they come here legally, for example, because they still need a roof over their head. So all of that is putting pressure on the houses that we need to give homes to people, our own people who've lived here all their lives, and of course other people as well, and new households that are forming. So we have high demand, so the way that we deal with that is we build more houses, and across the piece we then have more houses for people to rent, more houses that are affordable, and we're investing in social housing at the same time.
I'm pressed for time. I want to jump in. The Renters Reform Bill that has been pushed off and pushed off, it's meant to protect tenants so that they are enabled to stay in their homes for longer effectively. Michael Gove denies that there is any delay. Is it actually going to be put forward? It's going to be in the King's Speech next month?
Well, I'm very proud of this legislation. It's already been introduced into Parliament. We've all stood on a manifesto commitment to abolish that Section 21, which is what you're talking about. That's the no-fault eviction clause, which we know is a leading cause of homelessness. We will bring that bill forward, hopefully very, very soon, because it's important that we deliver on that promise to young people.
But not in the King's Speech next month?
Well, obviously, only the King knows what's in the King's Speech. It will be brought forward as soon as parliamentary time allows, and I'm pretty optimistic that will be brought forward very soon.
And in terms of, there is a crunch going on in terms of trying to fix the housing market in Britain. Prices are falling, but affordability measures are actually strained. What are you going to be able to do about it, other than a very, very long-term measure of building more homes?
Well, we have to take those long-term decisions now. It's right that we're doing that. And when we do that, there will be some people who are upset with that. You can't please all the people all the time, specifically not in this housing brief. So we do have to build houses, we have to build them in the right place. But if you look, you talk about affordability and pressures on people's budgets, and we really do know that the cost of living is impacting people. people, but that is why the government has put billions of pounds of support into cost of living packages, helpful energy bills. It's also why the Prime Minister is so focused on getting inflation down, because it's those costs that are eating into people's budgets and really putting pressure on their ability to afford mortgages or rent. So we need to carry on with that plan and make sure that we do get inflation down.
Rachel McLean, the UK Housing Minister, thank you so much for joining us here on Bloomberg Television. Francine, so we do know now at Conservative Conference that there is going to be a cabinet meeting, and we do expect more decisions now on HS2, but the question over building more homes, over whether there'll be more tax cuts from this government as we head into a general election pretty soon, those are still question marks, Fran.
What a great interview. Caroline Hebker there from the UK Conservative Party conference in Manchester. Now on to UK retail, and Sharon White plans to step down as chair of John Lewis Partnership after struggling to turn around the beleaguered UK department store chain. Well, White has been trying to return employee-owned John Lewis to profitability following the pandemic and the cost of living crisis. Let's talk more now with Bloomberg's Sabat Meetings. Sabat, first of all, congratulations on all of your reporting. So you cover UK retail, and it's, a lot of the high street, I guess, at the moment is a crisis. John Lewis is a slightly different business, but with the chair stepping down, it's really important to put focus on why it's been so difficult to turn this company around.
I think John Lewis, sort of separate from most businesses in UK retail, is owned by its employees and always has been. So unlike others that may pay dividends out to shareholders, John Lewis has always paid its profits to its employees. But the trouble is, John Lewis has a big store footprint. Sharon White came in at a time when she faced COVID. Her job was to try and pivot that business to online retail. She took some tough decisions with closing stores, but ultimately John Lewis has to make some difficult decisions. And when the partners own the business, it's very difficult to take those drastic measures it may need.
So what does it need? I mean, is this a lease problem? They also have Waitrose. So is it the way that it's run, or they're just not selling enough?
I think, Sharon White came in and she made this promise that she wanted to make more and more of the revenues from outside retail. So you had kind of a non-retailer coming in saying, she wanted to perhaps make money from rental homes. She did a partnership with Aberdeen. There was a deal with Ocado, which is no longer. So John Lewis needs to raise money. It's thought about doing some sale and leasebacks with some of its Waitrose stores, some of the more desirable ones. But ultimately, John Lewis has this sort of never knowingly undersold. It's famed for its customer service, but it does seem to have lost focus on perhaps its core retail, and that's really the problem we're in today.
Yeah, I mean, I feel when you're middle-aged, you start liking John Lewis. There's also this, other iconic brand, Dr. Martens, and they're opening a huge storefront in the UK on Oxford Street.
Oxford Street. I mean, who wouldn't want to be on Oxford Street? It's one of London's prime shopping destinations. But definitely, Dr. Martens coming is a real show of confidence in that street, which has been a little beleaguered of late. We've had Topshop, we've had BHS, we've had House of Fraser, Debenhams have all left empty spaces on that street. So for Dr. Martens to come in, with IKEA coming in as well, it is a show of confidence. But we do know there is money to rejuvenate the site, and as part of that, they've been giving quite generous rental deals. So whatever Dr. Martens may have been offered, we don't know, but potentially there's been some kind of incentive to go there as well.
So interesting, Sabat. Thank you so much, Sabat Meetings there at the very latest on the health of the UK high street. Coming up, as Sam Bankman-Fried's FTX crypto trial begins in the US, we also take a look at the timeline of how we got here. That's next, and this is Bloomberg.
Shopee, Shopee Live, Festival is here, we are Shopee Live.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that my ancestors have practiced for centuries.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacroix here in London. Now, almost a year after the collapse of the crypto exchange FTX, its founder, Sam Bankman-Fried, is about to face trial in New York. The 31-year-old has pleaded not guilty to 7 counts of fraud and conspiracy. Bloomberg's Kay Lyons looks at the rise and fall of one of the biggest names in crypto.
In the span of 3 years, Sam Bankman-Fried became one of crypto's biggest stars. In May 2019, Bankman-Fried and business partner Gary Wang founded FTX. Its goal? To create a safe and responsible platform for traders. By October 2021, venture capitalists had poured millions into FTX, and A-list celebrities like former NBA player Shaquille O'Neal, model Gisele Bündchen, and comedian Larry David had endorsed it. That same year, the firm was valued at $25 billion, and users soared to more than 5 million globally, at least 1.2 million of them in the US. The FTX name became well known, appearing on t-shirts, in commercials, and even on an NBA arena. By early 2022, the Bahamas-based company's valuation skyrocketed to $32 billion. FTX had become one of the world's biggest crypto exchanges. Bankman-Fried's net worth climbed to $26 billion, and he said he wanted to do good with his money, following effective altruism.
I both think it's not what I should do with my money. I think I should be thinking about how I can help the world with it.
The then 30-year-old also became a major political donor. He contributed tens of millions to bipartisan political action committees and frequented Capitol Hill to be a voice for his company and the industry. At the time, he had no plans to slow down.
I'm going to be here for the long term. I have no plans to leave. That is not something that is on my horizon.
But in November of 2022, things began to unravel. CoinDesk reported that the crypto hedge fund Bankman-Fried had also founded, Alameda Research, had a significant portion of its assets made up of FTT, a token that FTX created. In response, on November 6th, CZ, the CEO of rival crypto exchange Binance, posted to social media saying, quote, "We have decided to liquidate any remaining FTT on our books." The move triggered a massive wave of withdrawals, sort of like a run on the bank, and FTX didn't have the funds to meet them. In a rescue attempt, FTX reached a deal with Binance to sell itself, but Binance backed out.
It became very quickly, there was a lot of funds missing, like to the tunes of, double-digit billions. I couldn't trust any of the information in the data room.
So by November 11th, it was over. FTX filed for bankruptcy and Bankman-Fried resigned as CEO. That same month, he apologized at a public event.
I made a lot of mistakes are things I would give anything to be able to do over again. I didn't ever try to commit fraud on anyone.
But just a few weeks later, Sam Bankman-Fried was indicted, accused of misappropriating billions of dollars at the cryptocurrency exchange.
It's fair to say that by anyone's life, this is one of the biggest financial frauds in American history.
Kaylee Lyons there with the story of the FTX and Sam Bankman-Fried saga so far. Coming up, Sequoia Capital's Rolf Botha spoke to Bloomberg about the AI frenzy. That's coming up next, and this is Bloomberg.
I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Business Week magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m.
My phone, my wallet, has...
So we've been making very active seed investments. 60% of our investments over the last 12 months have been in and around AI. Now, I was in Silicon Valley in the late 90s, and there was a lot of hype around the internet. And we went through a trough of disillusionment at some point around 2002. And I think in the long run, the internet was far more profound than we could have imagined at the time. I think the same may be true for AI.
Of Sequoia Capital, managing partner and Stuart Roloff, both out there speaking to Emily Chan about the AI frenzy. Now, while investors have piled into AI bets this year, Wall Street has also been slow to succumb to the new technology. Computers have struggled to decipher noisy markets, but there are signs that this is shifting. Now, for more, let's bring in Bloomberg's cross-asset reporter and author of today's Big Take, Justina Lisa. Justina, first of all, congratulations on a wonderful Big Take, really interesting, and it's amazing to see the advancement of AI technologies in certain industries, and you kind of take stock of what it means for Wall Street. So is it tougher or easier for Wall Street to take advantage?
So Wall Street uses a lot of the productivity hacks that we're all really excited about. I mean, when I spoke to hedge funds earlier this year, they're using ChatGPT to summarize research, write code. But I think the holy grail in finance is always to use machine learning to kind of predict markets and decide what to trade based on that. And I think that is, a lot of people are finding, much harder than even teaching ChatGPT how to write Shakespeare.
So how does it, if it's harder to apply to AI to finance, where does it go? Is it more algorithms that they need to work on?
Well, a lot of hedge funds are saying that they're still trying to crack this puzzle and they're making a lot of progress. I think what they're finding is you need to fine-tune a lot of these methods coming from Silicon Valley to financial data, which is a lot noisier and it can change from one regime to the other. And you actually don't have as much data as you have in photos of cats and dogs, for instance, right? Because you can't just generate new days of trading data. And so I think a lot of hedge funds are trying to work within those limits and trying to see how can we adapt those techniques to what we do here.
So could it at some point pick stocks for me? Is it easier to kind of look at balance sheets rather than talk about a treasury market?
I think it could possibly pick stocks for you with less manpower than before. Because so far, the track record of a lot of AI-powered hedge funds is not spectacular, but it's sort of roughly the same as a lot of human-run funds. And I've spoken to some investors who say, maybe that's good enough. But I think a lot of people are finding a lot of AI tools are really helpful. For instance, one thing that everyone likes to do these days is using something called natural language processing to read tweets or read the news and turn that into trading signals without a human ever having to read a word.
Okay, amazing. Justina, thanks so much. Justina Lee there with today's Big Take. I urge everyone to go and read it. If you have a Bloomberg terminal, just go to NI Big Take Go, or we'll also push it out on all of our social media platforms. Now, let's also take a look at some of the events that we're looking at for today. 1 p.m. UK time We'll hear from the Atlanta Fed President Raphael Bostic, who's participating at a roundtable discussion. 3 p.m. London time, the key data drop of the week. We'll get the monthly U.S. job opening numbers from the Labor Department. And then throughout today, we're expecting a number of ECB speakers, including Philip Lane, François Villeroy-Duguet as well. And 3 p.m. UK time, Bridgewater Associates founder Ray Dalio will also be speaking at the Greenwich Economic Forum. So up next, the Bloomberg Brief with Danny Berger and Matt Scranton.
So you built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve or help our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. We started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is that you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like I want to build out a true consumer-powered healthcare world, like one that is outside the existing system. And there's no greater force than government.
This day right here, I'm pretty good at. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close,
How long this was priced into the U.S. session,
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Here's the #1 tip when it comes to property investment.
Good morning from our world headquarters in New York. I'm Matt Scranton.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
A chorus of hawkish Fed comments dislocates the bonds. Loretta Mester suggests rates may be higher for longer.
At this point, I suspect we may well need to raise the Fed funds rate once more this year and then hold it there for some time as we accumulate more information on economic developments and assess the effects of the tightening of financial conditions that has already occurred.
Meanwhile, in Australia, the Aussie slides as the RBA keeps rates unchanged, but says some further tightening may be required. And Kevin McCarthy's job is on the line. Fellow Republican Matt Gaetz officially moved to topple the House Speaker, teeing up a vote that may shift Washington's balance of power. Very good morning. The balance of power is still with the bond vigilantes, that's for sure. But it almost feels as if the ligature which is around the bond market over the past 5 days has loosened ever so slightly. Yields come off their zenith, the 2007 high for the 10-year paper. ING this morning said the pushback by the Fed and those voices that you hear in the past 24 hours is against that rate protest that you have. The market is not keeping up with where the Fed want you to be. Now, the euro trashed and crashed yesterday by nearly 1% as the musculature of the dollar was really felt. Higher rates, higher dollar, and that momentum was there. Is there a disconnection from reality in the bond market as far as the euro is concerned? Nomura said yesterday in surveillance it feels like we should be at 101 to 103 already. Philip Lane comes out this morning, the chief economist, and says there is more work to be done. It's going to be hard to sustain lower gas prices, so we see this small inflection and move higher in the euro. The oil market is flat at the moment, but you can see we're just in the midst of trying to decide. We were down for 4 days in a row. We dipped below this $90 level on the yield spike and the dollar dislocation. It feels as if, or it felt as if, some of these markets were at a breaking point. Cities Moore says $70 is a possible price on the oil market. As Mazrui at ADIPEC, the UAE oil minister, says we're in the right place for OPEC policy. Danny.
Man, it's just when you think you've wrapped your head around oil, another twist and turn in that narrative with it dropping below 90. The other debate we're having in this equity market, man, is do we care about higher rates? Can equities charge higher, even if we're talking about 10-year yields at 4.7%? MSCI Asia Pacific, not so a tough session. China's off the map. It is golden week for the Chinese equity market for the region. Still, we're trading at the lowest level of this year for the MSCI Asia Pacific. We're down 30% from the top. Morgan Stanley says global funds have cut their China exposure to the lowest since 2020. Now, for the rest of this equity market, Europe claws back from a negative day yesterday. Just barely, though. I mean, we're basically unchanged. And S&P 500 futures, they're higher after ending higher yesterday. But man, this is the divide. It's really well encapsulated by Bank of America and Morgan Stanley. So Vita Subramanian over at Bank of America says that, yes, we can move higher, even if rates are higher for longer. But Mike Wilson, who's always bearish over at Morgan Stanley, says no. Like me on a bad day, stocks have had a change in personality, a distinct change of personality is what he calls it. And they care about rates, Manus.
There's no schizophrenia on this show, absolutely not. We're two very well-centered people at 3 a.m. this morning when I come in here. Look, the debate is this, is what price do bonds need to go to clear the upcoming supply? We'll talk about that with Marco Papik in a moment, but we both struck by what Ed Udani had to say, and this was it. The man who christened bond vigilantes that we've quoted so often. The worry is that the escalating federal budget deficit will create more supply of bonds than demand can be, requiring higher yields to clear the market. That worry has been the bond vigilantes' entrance to you. Now, that is not the view of our bond guest in 45 minutes from Clock Tower, but that is Udani laying out the roadmap. Danny.
Yeah, and I love what he continues to say that, is this on the Fed's radar, Manus? If higher yields aren't yet on the Fed radar, then they should be.
Exactly, and that's the concern about the constriction of FCON. Let's take those thoughts to our guest host this morning. It is Remy Olupitan, fund manager over at Schroders. Remy, good to see you this morning. Should the Fed now be worried about this? It almost feels as if, as JP Morgan say, the bond market has become dislocated from its typical drivers. Is it showing signs of dislocation to you? Good morning.
Good morning, Manus. Not at the moment, because actually we think that this is what the Fed wants. What we need to be careful of is the speed and the level, but I do think a slight increase in bond yields is consistent with what the Fed is trying to do. They've made it quite clear that further rate hikes are still on the table and that yields will be higher for longer. And as a consequence, the 10-year was quite dislocated and really was struggling to accept that. And I think what we have seen is some acceptance.
Yeah, I mean, it's a great point because we've been saying for how long the bond market hasn't woken up to higher for longer. Now that it has, we're all of a sudden all freaking out that it's woken up. So tell me, what should I freak out, Remy? At what level do I get worried?
To be brutally honest, we think that it's starting to look quite attractive now at 4.7. position. But there's always risk of mistakes, and typically with markets, things do overshoot. The 5% level is quite a scary level. We also need to focus on real yields, because that is where you're getting the transmission. I mean, there has been some concern that monetary tightening hasn't been transmitting into the US economy. Now that we're seeing long-dated bond yields rise and real yields rise, I think that's coming through. So 5% is a number to be wary of, and 2.5 on the US 10-year real yield is a number to be wary of as well.
Okay, so you've put your stake very clearly down, 2.5%. On the real yield. What would that do to tech? And the reason why I asked you that, Danny, myself, and the team have been looking at some of the balance sheets, and a big shout out to Dan Curtis on this. The balance sheets within tech. If you look at the cash that Meta has, $53 billion, Apple has $167 billion, with real rates going to 2.5%, which is a risk, as you say, in the market. Do these balance sheets bolster against that real rate of 2.5%? Is that enough to bolster big tech?
We think that that's enough to bolster big tech. I mean, these balance sheets are in a very strong position. Nevertheless, there's an issue with regards to the price and what is the right price. And I think that that's the debate markets a lot of investors are having, because with higher real yields, there's that opportunity cost, the valuation debate. I think that that's what's causing this temporary headwind for tech. Once we get through that, investors will start to focus on the fundamentals. A lot of these companies are in a very strong position, but there are a lot of weak hands, not in tech, but in other sectors.
Can I also show you something else that's a little bit puzzling for me? Perhaps on the other side of things, our jump spreads right now. I mean, they tightened significantly this year despite everything, banking crisis, what have you. Triple Cs are at 848 basis points. Prior recessions, they're usually around 2,000. Should we be bracing for something much worse in this junk market?
Yeah, that is puzzling. I mean, there are two things that we have to recognise with regards to jump spreads at the moment. Again, similar to the argument on tech, a lot of these companies are in a strong position. I mean, they really benefited from very low rates for many, many years, and they were able to really sort out their balance sheets and extend the term of their financing. So just starting from the starting point, they're in a strong position. We do have a wall of issuance coming towards the end of next year, early 2025, so that will cause some tantrums, and there should be some widening of spreads. But a lot of investors are looking at the absolute yields. And at the moment, those absolute yields are really attractive, specifically relative to everything else you can own. And so I think that that is driving some demand.
And that is the conundrum, isn't it? Whether you want to take high-grade credit, let's say, with less volatility than equity. With that in mind, where does credit sit for you?
So we have been nervous about credit, particularly high grade, for part of the reasons you've mentioned, but also the duration. Because we think that the volatility has changed. A lot of the high grade, high quality investment grade credit, particularly in the US, you're looking at a duration of 7 to 8 years. So actually what you are trading is nominal bonds with a little bit of a spread. So a lot of the performance has been driven by the volatility in rates. So you're not really getting that corporate fundamental benefits that you want. And I think that that's one of the reasons why high yield bonds have performed quite well, because they have less duration sensitivity. And as long as we feel that the US economy will remain resilient for a bit longer, these bonds can outperform.
How much of that is tied to energy too? A lot of these companies are obviously energy companies too, and oil prices flirting with $100 a barrel.
That is fair. That is fair. I think you're right in that the composition of some of these, of the credit universe has changed, and you do have a lot of sectors, particularly within energy, that are in a very strong position. They are seeing an increase in their share prices, and that gives a lot of investors some confidence. I think what we have right now is, again, about this debate with higher bond yields and how we as investors need to accept this and deal with the reality of the next couple of years. I mean, even if we do see bond yields coming back, I doubt whether we're going to see the 1% and 2% that we were used to many, many years ago. And so we do have to be more discerning. The way we look at asset classes has to change, and there are some interesting assets that can survive this.
Yeah, a new regime, but I mean, one we can live with, one we can definitely find opportunities in.
I don't think we have a choice.
Very well put. Remy, I'm afraid that's all we have time for. Thanks so much for joining. That's Remy Olupitan of Schroders. Now here's some other stories, some top stories that we are tracking this morning. JP Morgan CEO Jamie Dimon says artificial intelligence is already being used by thousands of employees at his bank and is likely to make dramatic improvements in the workers' quality of life, even if it eliminates some jobs. He spoke exclusively with Bloomberg yesterday.
Technology's always replace jobs. Your children will live to 100 and not have cancer because of technology. And literally, they'll probably be working 3.5 days a week. So technology's done unbelievable things for mankind. But, planes crash, pharmaceuticals get misused. There are negatives. This one, the biggest negative in my view, is AI being used by bad people to do bad things.
And another Bloomberg scoop, Taiwanese companies are helping Huawei build infrastructure for a secret network of chip plants across southern China at a time when China threatens Taiwan regularly with military action. The island's tech companies may be helping US-sanctioned Huawei develop chips to effectively break the American blockade.
As elsewhere in Asia, Evergrande soared as it returned from a trading halt, driven by what appears to be bets on a penny stock, even as the developers fate hangs in the balance amid an official probe into its billionaire founder, Manus.
Okay, coming up, it is Gates versus McCarthy. As a Republican congressman officially moves to remove the House Speaker, could the balance of power be shifted? Plus, oil falls for a fourth straight day. We're live to ADIPEC Energy Conference in Abu Dhabi with India's oil minister right here on Bloomberg.
That's me, Max. I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Business Week magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in.
How did Jeff Bezos realize he could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made the stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
All eyes turn to the U.S. job market.
The jobs report,
it looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger wave than we expect.
The September Jobs Report, Friday on Bloomberg Television and Radio.
Well, I think the American people deserve to know the coalition that really governs them. And Kevin McCarthy likes to pretend that he makes coalition with conservatives, but all he really does is break his word with conservatives. The coalition that really runs this country is the Uniparty. It is the Biden, McCarthy, Jeffries government, and that is what we will demonstrate with this vote.
That was Representative Republican Matt Gaetz speaking to reporters after he officially moved to topple House Speaker Kevin McCarthy last night. Now, all of this sets up a high-stakes vote in a process that hasn't resulted in a speaker being removed since 1910. Joining us now is Bloomberg senior editor Bill Ferry's on this. Bill, of course, has extensive experience covering U.S. politics for Bloomberg, so no one we'd rather speak with. Bill, given how long it took McCarthy to become speakers, it was 15 rounds of voting. I remember we talked extensively about it at the time. How big of a surprise is this?
Well, it's not a surprise at all in the sense that there was a kind of a devil's bargain that Kevin McCarthy made to get elected on that final 15th round of voting, and that was to give one member of Congress. Any single member could have the power to essentially call for a no-confidence vote in his leadership. It's 435 members of Congress. The Republicans have just a narrow majority. There was always this kind of wild, hard-to-control right-wing group that was never crazy about McCarthy to begin with, and was really chomping at the bit to have a reason to go after him. Matt Gaetz is taking that step this week. We'll have to see how it plays out, but it's something that Kevin McCarthy knew from day one in his speakership was always likely to happen.
So this could all come down to what kind of support the Democrats are prepared to give to McCarthy. Look, if you step back from this, what is Congressman Gaetz doing, and what are the chances are that he will be able to pull this off? Do you think the Democrats will extract some concessions to get behind McCarthy? What's the feeling on the Hill at the moment?
There's a whole lot of different scenarios, different ways this could play out. As you said, with the narrow majority Republicans have, if Matt Gaetz can get 5 other members of the Republican side to join with him and all of the Democrats, that could be all they need to oust McCarthy. I don't know if the Democrats really want to go down that path. They could also, as a bloc, sit out the entire vote. That would leave, if McCarthy just needs a majority of those voting to stay in power, he would have still the majority of his own party backing him, because this is really a minority that's looking to get rid of him. What is Gaetz doing? He has said he wants to lay the groundwork for a potential President Trump return to the White House. And he wants to go after Republicans he doesn't think are willing to fight hard enough. That's part of his strategy. And also, he has just found this to be a good fundraising mechanism. He has sent out emails trying to fundraise off of his efforts to oust the Speaker.
So what's the timeline for this then, Bill? What happens next? What is the process?
Well, under the House rules, they have to have this vote that Gaetz is calling for within 2 legislative days. You can extend that out quite a bit. One legislative day could just go on endlessly as long as they don't conclude it. But it does seem like Kevin McCarthy wants to get this over with. He said, bring it on, I'm ready to face this. He could call for it as soon as today in Washington. Certainly by Wednesday in Washington, we could know the results or have a good sense of where this is going.
Okay, it's going to go down to the wire. It's going to be interesting to see just where the Democrats come down on this bill and whether they do sit it out completely, as you say, and just leave it to the Republicans to deal with their own in-house laundry, so to speak. Bill Ferry's on the very latest from Capitol Hill. Quick check on the markets this morning. That level of deep concern that something might break just seems to have paused. Equities are up by 1/8% at the moment. The dollar is still strong and had a mighty day yesterday. Yields just tip a little bit higher now. 468 is where we are. And crude, Mazrui from the APEC conference, the UAE oil minister says we're in the right place. That's the state of play on markets right here on Bloomberg.
Hey, do you know the dark secret of e-commerce sites like Shopee, Lazada or Q10? If you think they are making money from selling products, you are just half right. Earning from commission per product sold is just a small profit of their earnings. The big profits comes from promoting other people's product to their subscribers list. And they're charging a whopping amount of a few $1,000s each. And that's email advertising.
Hey, my name is Nicholas Ding. Currently I'm making money from email advertising, which is generating income from the internet by sending emails. I'm sure many ordinary people how to do the same too. The business is suitable for retirees, full-time executives, or even if you intend to earn an extra income from home on a part-time basis. If you want to know how to do the same, in my next web class, I will pull back the curtains and show you behind the scenes how we do it. In a show of value, I'm going to do something different. I'll be showing you for free. Click the link around this video, put your name, email and phone number on the next page and click on the button to book your seat. Why am I doing this? Because thanks to this email business, it has allowed me to spend time with my loving family, quit my dead-end 9-to-5 job, travel around without the need to apply leave, and basically get to do things that I could only dream of before this. It does not need any technical skills. You do not need a lot of money to get started. There is no physical products involved, and you can use other people's money to build your subscribers list. If this is something
my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Now, Birkenstock is looking to raise as much as $1.6 billion from its IPO. Accompanying filing says the German footwear maker will sell shares in a range of $44 to $49. That would value Birkenstock at over $10 billion at the top end of the range. Filing says investors include the Norwegian Sovereign Wealth Fund and T. Rowe Price are interested in buying shares. Manus, I just want to know, when are my Dior Birkenstocks coming in the mail? When are you sending them over to me?
Listen, I know you're always trying to say to me, now that I'm earning US dollars, I'm going to be able to be generous towards you. All I've got to say is, so we both, it's interesting on this show. I look at normal Birkenstocks. What were you looking at? Dior Birkenstocks. So I look at the men's. $1,000 for a pair of men's Dior Birkenstocks to go to the beach. Are you having a laugh? I mean, maybe, but then you said to me it's a lifestyle thing.
They're not just shoes.
What?
Yes, they're not just shoes. It's a lifestyle. Imagine yourself on the beaches of the south of France wearing your Dior Birkenstocks. It feels right.
Let me tell you this. I've done a lot of the south of France. I've done a lot of Saint-Tropez. And I tell you what, I didn't do them in $1,000 shoes. I'll wait to see you in your Birkenstocks when you make it to here. But should we talk about, let's talk about Taylor Swift, shall we? I mean, the power of this woman, never mind her music and her record sales. We're not football, economic impact. It's in the NFL. The TV ratings, they've just had a massive bump, an increase in the money bet on the games, amid the excitement, of course, with her relationship, or her speculated relationship, with the Kansas City's Travis Kelce. So, would you watch more football because Taylor Swift is there? Would you? Come on, tell the truth.
Okay, I honestly I wouldn't. I'm not the biggest football fan or Taylor Swift fan, but you literally can't avoid it, Manus. It is everywhere on Instagram. It is literally everywhere. But here's my fun fact from last quarter, the third quarter. Taylor Swift, Beyonce, and Barbenheimer altogether added $8.5 billion to growth in the third quarter. She is single-handedly, her and Beyonce are supporting this American economy.
Well, I tell you what, there's a few jobs that got added in the temporary side with all of those things. I mean, some of the facts on this Taylor Swift story. Putting in 2 million additional female fans to the network. So the audience, NBC Sunday Night Football drew an audience of 27 million viewers. That is up 22% on last year, and 2 million more women watched. And the betting on, by the way, his jersey sales are up 400%. He can afford the Birkenstocks of $1,000, can't he?
I love that. Taylor Swift, let's be honest, is the breadwinner in that relationship, but she's doing so much for his career. She's doing so much for the NFL.
So much for the American economy.
Industry. Exactly.
Berapa juta tu? 1 juta, alhamdulillah.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs and topics of the world, deep minds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI
But more than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next school. But then our take was, that's great. You can have these amazing giant general models. What would be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models are like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things. But that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. A chorus of hawkish Fed comments dislocates bonds. Loretta Mester suggests that rates may be higher for longer.
And at this point, I suspect we may well need to raise the Fed funds rate once more this year and then hold it there for some time as we accumulate more information on economic developments and assess the effects of the tightening in financial conditions that has already occurred.
Meanwhile, in Australia, the Aussie slides as the RBA keeps rates unchanged, but says some further tightening may be required. And Kevin McCarthy's job is on the line. Fellow Republican Matt Gaetz officially moves to topple the House Speaker, teeing up a vote that may shift Washington's balance of power. Now, while the drama happens in Washington for this equity market, it's all about the debate unfolding of how much we need to care about higher rates. It definitely dented the Asia session. China is offline for the Golden Week holiday in China, but still the rest of the MSCI Asia Pacific falls more than 1%, almost 1.5% for the lowest level of this year, down 30% from its previous high. European equities, they have run out of steam. They started the morning higher, now we're just ever so slightly lower. Meanwhile, S&P 500 futures, those also appear to be running out of steam. Manus, I know you've got the bonds in front of you, so I can't help but wonder if this has to do with the turnaround in this bond market, that equities are struggling now to get a bid.
Well, I think maybe the bond vigilantes set their alarm clock for 5 a.m. in New York, because in the past 30 minutes, I mean, we just had that light rollover in the bond market. The Fed speak overnight is very simply put from ING. It's the Fed pushing back against the rate market's protest. In other words, only pricing in 50% probability of another hike. You can see behind me, yields are just incrementally higher. Are you in some kind of a dislocation from normality, according to JP Morgan? That's their view. Schroders have just been with you and I saying real rates will go to 2.5%, 2.75%. And headline rates on the 10-year will go to 5%. We're already at the highest level since 2007. It's the velocity of the change in rates, perhaps, rather than the destination that is most disconcerting. Ed Yadani says that it is about deficits and supply that are driving the narrative for the bond vigilantes. Now, the dollar flexed its muscle yesterday, rocking higher against sterling, against the euro, and again, the euro just makes a very, very incremental inroads to show some green on the screen. It tanked by nearly 1% yesterday. The chief economist has come out, Philip Lane, and said there is more work to be done. It's going to be hard to sustain these gas prices, the lower gas prices again, so an energy concern going into the winter. Crude is at $88, sub 90 bucks, and it had been dropping for 4 days in a row. So we're just trying to put it in an 0.8% higher. But again, it's the yield spike and the dollar strength that has sort of capped that run in the oil market. In ADIPEC at the UAE, of course, you've got Masroui, the oil minister there, saying we're on the right path. So there seems to be no relent from OPEC Plus in terms of the narrative about the cuts and the implementation of those. Danny?
Manus, I find this debate really interesting of at what point are we worried about how high yields have gone. As you mentioned, Schroeder said that it's not until after 5% that we should actually be worried. But Ed Yardeni says that the Fed should be worried now, that they should wake up to higher yields. The question is, are we unduly tight right now, given where the level of yields are, or does it just make sense? Is this just a logical pricing of higher for longer?
Or as Clock Tower said, and we'll catch up with Marco in just a moment, he said he wouldn't catch a falling knife. He salutes those people out there in the bond market and say, now is the time to pick up duration. But it's not the base case for Clock Tower. So stay tuned, another 10 minutes, and we get the very latest from Marco Papig at Clock Tower. Danny?
Well, Manus, certainly the JP Morgan CEO, Jamie Dimon, has had some thoughts about this very topic. He's been warning clients and investors to prepare for a worst-case scenario of interest rates at 7%. He spoke to us exclusively on the sidelines of the JP Morgan Techstars Leadership Forum in London.
Can it go to 7%? The answer is yes. Are there factors that would drive it, higher than, where it is today? 4.5, 4.6, or 4.7 over the 10-year bond now. Yes. Is supply and demand could push out? Yes. I'm just saying, be prepared for it.
So,
and then the worst case is stagflation. Higher rates because you have a booming economy. There's a lot of competition for capital. It's not the same thing as stagflation.
what are the ripple effects of the stress of that 7% rates on business, on your growth?
Well, I'm not worried about JP Morgan. JP Morgan, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too. That risk management is not the same thing as guessing the future. What risk management is looking at the range of potential outcomes and being able to say to yourself, we can handle this, we can handle this, we don't really expect it, and we can handle the in between. If you bet your company on one outcome, so I think all companies do that. Every company's got different exposures. Input prices, output prices. Some interest rates don't matter. Some it's the price of mozzarella. So what's your business? Your business is different. So, but I think we don't know the effect of these things in the economy. So they may we may have a soft landing, we may have a mild recession, we may have a hard recession. Obviously there are potential bad outcomes. The worst one would be economically is stagflation, where you have low growth, high interest rates, and obviously if that happens, you're going to see a lot of people struggling.
Regulators have proposed new capital rules that banks have said will make it tougher for Americans to get a mortgage. But I'm curious, when you look across the firm, what businesses are going to have the biggest impact?
When you get into the specifics, it really matters how the ultimate rules about mortgages and small business loans, et cetera. In general, it makes, what I don't like about it, for example, it punishes diversification, operating risk capital, and GSIFI. And diversification is one of the true free lunches for a bank that protects it. And I don't understand why they do that. And I just, we're going to be responding. Hopefully it'll be modified and thoughtfully done for international purposes. And mostly, America's got the best financial system the world's ever seen. And that includes hedge funds and private equity and private capital, all things like that. But this is, I say the private equity hedge funds are dancing in the streets, and this time they're being quite public about it, because this is going to push a lot of stuff out of the banking system. And if that's what the regulators want, so be it. Is that good for America? I don't know.
Some great lines there from JP Morgan CEO Jamie Dimon speaking exclusively to Emily Chang. So the bond rout continues. You've got multi-year highs. The Fed speak is ratcheting up, and the rates market. Is it a protest from the Fed against this rates market? Let's get to Marco Papich. He is in the west coast of America. His Clock Tower Group does not recommend buying or trying to catch a falling knife in this market. This is what you've got to say, Marco. We do not recommend trying to catch a falling knife. Bonds are not selling off today because of America's poor fiscal profile. The US is not in a debt trap, but they may be in the future. So a very good morning to you. Explain to me then why we've had such a violent shakedown in this bond market at the moment. Good morning.
Good morning to you too, Mass, and thank you very much for having me on the show. I think that this move in bonds is, at this moment, purely because of the optimism in the U.S. economy that was severely underestimated by all the Fed watchers. They thought that somehow the 12th Olympian gods in FOMC could somehow slow down the economy with Fed rate hikes. Of course, what was severely underestimated is the strength of the U.S. consumer. And what continues to be completely misunderstood by almost everyone in the markets is that there is no excess savings. That is a completely vacuous argument. U.S. households have far more cash in their almost perfectly clean balance sheets than anyone really thought. And so that is really powering the economy. And as it does so, bond yields had to reset to this collapse of the recession narrative that's occurred over the last couple of months. The problem, of course, with my view, is that if that's true, then that means that higher inflation expectations or some sort of a debt crisis in the US is yet to be priced if it does get priced in, which means the move on the yields could go higher from here.
Okay, you say that you're in the mild inflationistic camp, 3 to 5% is where we're going to settle. Has that reality hit home, Marco? But more importantly, if that is your reality, then what is the reality of where bond yields actually get to?
So when you think about a 10-year fair value yield, there's really three components to it. One is term premium, which has risen because QE has ended. Then you have the R star, which is what we were talking about until now, just a healthier U.S. consumer than anyone really thought. The neutral rate is therefore higher. The long-term inflation expectations hasn't budged at all, Max. So I'm in this mildly inflationary camp of, let's say, 3% for the rest of the decade. The 5-year forward is basically telling me we're at 2.4%. It's nailed to the ground. So that's your long-term inflation expectations. A little bit forward are not much higher or lower. And that's what's really fascinating to me after all this extraordinary fiscal stimulus that we've had, after basically the Fed being way behind the curve in 2021, in my view still being behind the curve. There's been no rise in long-term inflation expectations. And so when you put all those components down together, I think the fair value is somewhere closer to 5%. But don't assume that just because it's around 5%, we're there and so people should buy bonds. No, there's so many investors.
Why not, Marco? Why can't I buy bonds right now? We're almost at 5%.
Right, so because so many investors are holding hundreds of billions of bonds with the idea that the fair value is 3 or 3.5, and if it's at actually 5, then it's likely the yields will overshoot as many investors sell their portfolio of basically overvalued assets.
Marco, with that landscape that you just laid out in front of us, you also put forward the thesis that an outright move to yield curve control in the United States of America in the long term, I mean, you're not saying it's next week, you're not saying it's at the beginning of next year, we're going to get our comeuppance as a result of this largesse, the unnecessary fiscal stimulus. But what could invoke YCC? Because it's quite a radical thing to say that the US bond market would need YCC. How and why would that come to pass?
I think that would be some sort of an uncontrolled move in bond yields towards what you had Jeremy Dimon talk about, like 7% in the 10-year yield. I think that let's take it one step at a time. There is a self-correcting mechanism where once bond yields go over 5%, given where oil prices are, given where the 10-year yield will be at that point, you're starting to have a lot of headwinds to the economy. And if recession risk rises, at that point, I think yields would come down. Folks would start moving towards the safety. So yeah, I mean, that would be your self-limiting mechanism where I don't think we would need yield control. But if we get an uncontrolled move in bond yields, as you saw with the United Kingdom earlier in the year, what did Bank of England do? Or for example, after SVB, what did we do in the US? We instituted the Bank Term Funding Program, which is essentially an American style of European LTROs.
Well, Marco, to that point, we're at this moment, and again to that point of the private sector, we're at this moment where debt is moving out of bank balance sheets and increasingly into non-banking financial institutions. And we have a Fed whose policy is transmitted through banks. Are we about to face a crisis of bond markets that can run away without that helping hand of the Fed?
Well, yeah, I mean, if there is no helping hand of the Fed, of course we could. Absolutely. As I said, if the fair value is 1.5% to 2% higher on the 10-year yield than most investors have thought, then many are holding overvalued assets on their balance sheet, and they will start dumping them. And in that situation, of course, you have this uncontrolled move, the Fed will step in. And so I think that right now, investors are in a very, very dangerous moment. We're traveling with events, and I think the only real view you can have is on the 10-year yield, and then you have to watch how policymakers react to it. And if the
Some blistering warnings from there, and I'm going to quote you again. I mean, I got to say, I love this note. First of all, you put yourself up as being a heretic. It's brilliant. But yourself and the team there say, I mean, I wish I could be so honest at 5 a.m. on the show. The Fed is merely traveling with events. It's a price taker in capex in this cycle defined by structurally higher aggregate demand. I mean, what did the Fed try to do in the past 24 hours? Because the rates market is fighting against the Fed. So has the Fed got to do more to regain control here, to regain the narrative?
I'm not sure that that's what they need to do. I mean, the 10-year yield is in many ways doing what they couldn't do, which is slow down the economy. And that's the point. That's the argument for buying bonds right now. Well, okay, this is unsustainable. Well, we'll see. We'll see which level is unsustainable. Market moves and paradigm shifts, when they get priced in, they tend to overshoot. That's why I'm not a buyer at this moment. But the point is that as the 10-year yield goes higher, that does increase borrowing costs for the economy, and that will slow down the pace of growth, even with my quite bullish view of the U.S. consumer. And so I don't think the Fed has to regain the control of this. I mean, it really depends what they're trying to accomplish. My issue is that I'm not really sure what they're trying to accomplish. I'm not sure that they know either. And that's why
Marco, you write in your note that it's clear that the Fed is pivoting for largely political reasons. I mean, that's quite the statement. Is it that clear? Well, why is it clear to you that it's political reasons behind their actions?
I think the reason for that is that, inflation has fallen down almost purely for supply reasons. It is very difficult to see any sort of impact on demand by the increase in the Fed funds rate. U.S. consumers have just blown through 5.5% in terms of Fed funds rate increases. Continue to consume. Auto sales are up as rates are up. A lot of that has to do with very strong real wage growth. And so what I'm saying is that if the Fed really wanted to get us to 2%, they would have done that by increasing rates more. Instead, they're pivoting away from that, they're pausing, right as we get confirmation that the economy is actually quite robust. And so I think the fact that we're 12 months ahead of the US election, they don't want to be political, they don't want to be perceived as political, which they would be if they induced a recession for the sake of 2% CPI. I think that that is definitely playing a role in their pausing, but they're pausing as they pause and as investors realize that growth is much healthier than it is, that there's really no reason to hold bonds at 3.5%, 3.75%, 4%. You want to dump them, you want to sell them off, and that's creating this bond yield increase. If they didn't respond to that with some sort of a way to talk down the yields, that would be an uber dovish move that will definitely reveal that they have, sensitivity to a very epic election coming up.
Okay, it's certainly going to be epic, and I'm delighted to be on the shores of the US to watch it. Mark, let's give it a second go. I'll maybe get the name right this time, Mark Puppich. Clock Tower Group with his calls on bonds, politics, and an epic election to come. Thank you for staying up in the midnight hours on the West Coast. So the oil market is trying to steady itself. It's virtually flat at the moment. 90.68. We dipped for 4 days in a row into this session. We're live to ADIPEC in Abu Dhabi.
Saya Dr. Bazrul, pemilik syarikat Madu Lohaliah. Saya berniat
live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
People ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
When you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder.
This is Bloomberg Brief. I'm Dennis Grandy in New York, Danny Berger at London HQ. The oil markets are grappling. We've done 6% since the middle of last week. Lots of opinions out there. 90.69 is where we trade at the moment. Flat at the moment on Brent, and 88.89 just ticking into the green for WTI. Let's get to Yusuf Gamal El-Din. He's in Abu Dhabi at ADIPEC, one of the largest oil conferences. So it's good to see you there. I'm missing it. I'm missing the